what is money? We use it every day. We earn it, spend it, and dream of having more of it. But where does it come from? It seems like a simple question, yet the answer is surprisingly complex. Money, in its essence, is a story. It's a story we tell each other about value. It's a promise we make to exchange goods and services. This story, however, has evolved drastically over time. From ancient barter systems to digital currencies, the forms money takes have constantly shifted. Each change reflects our evolving understanding of trust, value, and the very fabric of our societies. This journey through the history and future of money is a journey through humanity itself. Imagine a time before money. A time when the concept of currency didn't exist and people had to rely on their skills and resources to survive. You're a skilled hunter with a surplus of meat. Your hunting prowess has provided you with more than enough to feed your family, and you wish to trade the excess. You want to trade for a new spear, but the spear maker only needs grain. This creates a problem because you don't have grain, and finding someone who does can be time-consuming. This is where bartering, the earliest form of exchange, came into play. People would directly trade goods and services they had for those they needed. Bartering was simple. You traded what you had for what you needed. However, it required a double coincidence of wants, meaning both parties had to have what the other wanted. However, it was also inefficient. The process could be frustrating and time-consuming, often leading to disagreements and delays. Finding someone with the exact goods you desired and who also wanted what you offered was a challenge. This inefficiency highlighted the need for a more practical system of exchange. The need for a more practical system led to the rise of early currencies. Communities began to use objects that had a recognized value to facilitate trade. Shells, beads, and even livestock were used as standardized forms of payment. These items were chosen because they were widely accepted and could be easily traded. These objects, though diverse, shared a common trait. They held agreed-upon value within a community. This mutual agreement made trade smoother and more efficient. Later, metals like gold and silver, valued for their durability and scarcity, became the preferred form of currency. These metals were not only valuable, but also portable and divisible. The invention of coinage, standardized pieces of metal stamped with the mark of a ruler, marked a significant step forward. Coins were easier to carry and could be used for a wide range of transactions. Money, in a form we recognize today, the invention of loans added a new layer of complexity to the story of money. Initially, lending was a simple transaction between individuals. A farmer might borrow grain from a neighbor, promising to repay the debt with interest after the harvest. However, as societies grew more complex, so did lending. Institutions dedicated to lending, early forms of banks, emerged. These institutions didn't just hold money, they learned to create it. They realized that they could lend out more money than they physically possessed, based on the promise that borrowers would repay their debts. This system, known as fractional reserve banking, was a gamble. If too many borrowers defaulted, the bank could collapse. However, it also fueled economic growth. Loans allowed individuals and businesses to invest, expand, and generate wealth, driving the development of entire civilizations. Fast forward to the digital age. Physical currency, coins and paper notes, though still in circulation, represent only a fraction of the total money in the world. Today, most transactions happen electronically. We swipe credit cards, transfer funds online, and pay for goods with our smartphones. This digital revolution has fundamentally changed the way we interact with money. We rarely handle physical cash. Our wealth exists as numbers on a screen, representing deposits held in digital accounts. This shift towards digital finance has made transactions faster, more convenient, and global in scale. However, it has also raised new challenges, from cybersecurity threats to concerns about privacy and control over our financial data. Section 5, the alchemy of finance, creating money from nothing. So how do banks create money? It's a fascinating process that goes beyond the simple act of printing physical currency. It's a question that has puzzled many, from students in economics classes to seasoned financial experts. The simple answer, it's a matter of accounting. But let's delve deeper into what that really means. When a bank issues a loan, it doesn't typically hand out stacks of bills. Instead, it creates a new deposit account for the borrower. This effectively increases the total amount of money in circulation. The borrower can then use this new deposit to make purchases or investments. This process is based on the fractional reserve banking system, a cornerstone of modern banking. Banks are required to hold a certain percentage of their deposits in reserve. This reserve acts as a safety net. The remaining funds can be lent out, creating new money in the process. This is how banks can multiply the money supply. This system, while seemingly magical, is subject to strict regulations and oversight to prevent financial instability. Central banks, such as the Federal Reserve in the United States, play a crucial role in managing the money supply and ensuring the stability of the financial system. They set reserve requirements and use various tools to influence the economy. Section 6. The money go-round: debt, inflation, and the global economy. The story of money is inextricably linked to the concepts of debt and inflation. These two elements have shaped economies and societies throughout history, influencing everything from individual livelihoods to global financial systems. Debt, in its essence, is future money borrowed against the promise of repayment. It allows for the immediate acquisition of resources which can be used to fuel growth and development. It can be a powerful tool for growth, allowing individuals and governments to invest in education, infrastructure, and innovation. These investments can lead to long-term benefits such as improved quality of life and technological advancements. However, excessive debt can be a double-edged sword, leading to financial instability and economic crises. When debt levels become unsustainable, they can trigger defaults, recessions, and even depressions. Inflation, the rate at which prices for goods and services rise over time, is another crucial factor in the money equation. It affects purchasing power, savings, and overall economic stability. A certain level of inflation is considered healthy for a growing economy. It encourages spending and investment, which can drive economic growth and job creation. However, uncontrolled inflation can erode the purchasing power of money, leading to economic hardship and social unrest. Hyperinflation, in particular, can devastate economies, wiping out savings and destabilizing societies. Managing the delicate balance between debt, inflation, and economic growth is one of the key challenges facing policymakers worldwide. They must navigate complex economic landscapes to ensure stability and prosperity for their nations. Section 7. Guardians of the global piggy bank: central banks and the Balancing Act. Central banks play a pivotal role in the modern financial system. They act as guardians of a nation's currency, managing the money supply, setting interest rates, and ensuring the stability of financial institutions. Their decisions have a ripple effect throughout the economy, influencing everything from the cost of borrowing to the value of our savings. Central banks must carefully balance competing objectives, such as promoting economic growth, controlling inflation, and maintaining financial stability. Their task is akin to navigating a ship through stormy seas, constantly adjusting course to avoid hidden reefs and weather economic downturns. The effectiveness of central banks in steering their respective economies has a profound impact on the global financial landscape. Section 8. The future of finance. Will we trade in Bitcoin or barter for bread? The story of money is still being written. The rise of cryptocurrencies such as Bitcoin and Ethereum has challenged traditional notions of currency. These decentralized digital currencies operate on blockchain technology, a secure and transparent system that bypasses traditional financial institutions. Whether cryptocurrencies will revolutionize the financial system or remain a niche phenomenon is yet to be seen. However, their emergence highlights the constantly evolving nature of money and the potential for disruptive technologies to reshape the financial landscape. Section 9. Conclusion. Money, a human invention. Money in all its forms is ultimately a human invention. It's a testament to our ability to cooperate, build complex systems of trust, and create value from seemingly abstract concepts. From ancient barter to digital currencies, the story of money is a story of human ingenuity, adaptation, and the enduring quest for a more efficient and equitable system of exchange. As we stand at the cusp of a new era in finance, understanding the history and evolution of money is more crucial than ever. The choices we make today will shape the financial landscape of tomorrow and determine how this fundamental human invention will continue to shape our world.